today's show, how QLAC could bring relief from RMDs. Part 2 of this week's series on the impact of QLAC and emerging insurance products in retirement with nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Welcome to the show, Mike.
Great to be back.
Great to be back. Wow, I got to say, yesterday was a packed show of deep information on this whole new technology on QLAC, the emerging carriers that are bringing it to the market through DIAs. Everybody's probably sitting there going, Steve, I didn't know this was about. You just came from the actual, what was it, an annuity conference, and you said 20% of your audience didn't even hear about this. Or no, I'm sorry, 80% of your audience hadn't heard about it.
Yeah, just 20% had. So it's brand new. And also keep in mind that this only applies to fixed contracts. So for those people who are used to selling stocks, bonds, mutual funds, not in the game, which if you're a life producer, this is a great opportunity to go out and have something in your hip pocket that a mutual fund person and a variable annuity person will not have. And we think that that's why so many people have not heard about it, because the variable annuity companies aren't talking about it, your mutual fund wholesalers aren't talking about it. Only the people who are selling fixed annuities are really talking about how this can impact clients.
It's really great to have such an anomaly in our of all the inventory products that we have. Right? You're thinking about this is really so unique to our industry, and it's going to help so many affluent Americans actually manage their RMDs and their timeline, especially if they think they're going to have any kind of life expectancy that's going to go out into the 85, 95 arena. Walk us through some of the basic issues here, because I think this is, I can delay it now. How long can I delay it?
Yeah, yesterday we talked about how long to delay it and the 25% up to $125,000. But basically, income payments have to begin no later than the first day of the month following the person's 85th birthday.
Well, let me just stop you there. That is a huge timeline for the 2001 CSO mortality tables. Even females are dying at 84. So they're really letting you push this out. If you had any kind of longevity in your family, this would be huge.
Yeah, absolutely. And think about it from a financial planning aspect as well. You know, one of the things that we always talk to our advisors about is how do you get the most optimal return? How do you make sure that you'll never have 100% guarantee that you'll never outlive your money, because this is only 25% of your assets? But certainly when you're talking about an asset allocation plan with the appropriate mix of stocks, bonds, you know, all types of mutual funds and things like that, this gives you an opportunity to have a defined set horizon of 20 years. If you're talking to a retiree at age 65 and you have a defined period of 20 years, you have a reasonable chance of having a 90 to 95% assurance that you're not going to run out of money. If you do, then you have the QLAC popped in at age 85 to make sure that you have the income.
This is a huge tactic for retirement planning. This could be the new traditional backstop for your retirement. People generally are going to run out of money if they stay completely in equities, generally, depending upon the market, of course, but somewhere in their mid-70s, 870s. Now we're giving this ability to defer, which helps us in our tax issues, because I don't have to take the RMD till later on. How long, if I have to start taking money at 85, is this lifetime then? Yeah,
the payments can be a single or joint life, and it can be life only or life with cash options.
If I own the IRA by myself, I could still make it joint life with my spouse.
Absolutely, because think about your RMDs. You can use the different table to include your spouse to make sure that those RMDs continue.
Can I do that even though my wife may not have a significant retirement plan herself?
Absolutely.
So this is a huge issue. So we're now looking at joint life. I have to start at 85. That's the lightest I can go. But that delay from 75 to 85, that's 15 years. And many people are buying this DIA wrapped with a QLAC way before that time. So this could be a huge number. What are those numbers looking like? Have you seen any examples yet?
Well, I think that whenever you look at a 20-year horizon, you would have to have an income rider somewhere growing in the neighborhood of 9 to 10% in order to equal this same type of payout. So this could be a huge magnification of your income. What's interesting is that, again, we talked last session about you need to change the conversation. You know, this is maybe just 20% of the person's asset, or maybe even less, but life expectancies have increased by just 3 years over the last 20, but that has a 21% increase in income paid out if you calculate in those 3 extra years. That's a huge difference, and that's why Congress is addressing the QLAC.
I noticed not only the either life only, but you could get life with cash refund. Now, if I have life with cash refund, does that mean my let's say we're doing joint life, that I could actually pass on whatever residual we didn't use to our heirs? So it's not use it or lose it.
Not giving up control.
Yeah, you're not giving up control.
Yeah, and that's one of the myths about DIAs as a whole. Whenever you hear whether it's SPIA or whether it is DIAs, you're always concerned, oh, well, I'm losing up control. The fact of the matter is I believe only less than 8% of SPIAs and DIAs are annuitized with life only. They usually have some type of cash refund by 92% of it, so you're not losing up control.
Well, you know, that is an exciting feature, and I think we need to look at the difference between life only and life only with a cash refund. The spread may not be that big. So let's look at that. Here's the exciting part. I'm getting down to my favorite part. The increasing payment options. Now, I noticed you use the word CPI, not COLA, not inflation rider. Is there any difference in that?
Well, this is a specific index that includes the utilities and things like that. So, or excuse me, is urban CPI. And then you can also just go ahead by carrier, have a 1 to 5% simple or compounded, and this is going to be really dictated by the carrier. So most carriers will say, okay, you know what, I'm just going to do a compounded 5% option or something like that. So you really have to be selective about the few carriers that are out here. Now, we talked about backing things up as long as possible. This is an opportunity to say, you know what, I'm going to start doing my 25%, turning on the income at age 70, a little bit at age 75, and this is where this is really going to come into play.
We come back from the break. We're going to touch on some of these death benefit options and alternatives. This is a huge opportunity. QLAC, DIAs may be new to you. Just remember, you can talk to any of our advisors on this, the people that are really understanding this. Mike's one of the top guns in the United States. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the Practice Enhancement Company. Welcome back to our second segment. Of course, I'm with Mike McLaughlin, nationally recognized annuity expert. We're talking about QLACs, we're talking about DIAs, and if you're saying, Steve, I don't even know either one, again, remember, if you just write me, I'll be happy to walk you through this, send you some of the information that we already have. Talk about some of the death benefit options, Mike, because I was kind of all over this. I love the CPI, 5% compounded. Wow, I want to see the carrier that comes to the table with that. Yep. As well as my life with cash refund. So now I've covered off the liquidity issue. Talk to me about the death benefit options.
Sure, yeah. One other thing before we go to the death benefits, you know, with the CPIU, you know, this is a great thing when we talk about Social Security planning. We've talked about the impact of Social Security. One of the best things about Social Security is that it is inflation protected. So this is a great opportunity. If you were doing systematic withdrawals out of your mutual fund or your assets under management, by increasing that payout, you're really eroding that money quicker and it begins to snowball. Here's an opportunity to get base guaranteed income along with Social Security for that mass affluent, which is the target, and have two major foundational parts of your income strategy indexed for inflation. Now, speaking to death benefits, there are some limitations with death benefits. First of all, there's no return of premium plus interest. In current deferred income annuities for non-qualified and non-QLAC qualified accounts, you do have the opportunity for some death benefits plus as much as 3% growth to protect the beneficiaries. So that's off the table. That's one of the things that didn't fit into the QLAC legislations. However, the QLAC must have a return of premium or be no death benefit whatsoever. Now here's the advantage of that. You say, why would I want to throw my money here and no death benefit? If you're starting your income at age 70, 75, or 80, far before the 85th birthday, you would have a much higher payout because the carrier is not reserving part of that death benefit in there. So when you're going to CanX and just shooting out, I'm going to do something at age 80, at life in 10 years or whatever, you need to check to see what the actual death benefits are and peel back the onion to find out what's going to happen to the beneficiaries before the income is started, because there will be some nuances on that.
So it's ROP, not death benefit, really is the play.
It's pure return of premium. And think about what you're doing here. You're taking minimum required distributions. You're just taking that off the table. And so if you were going to do RMDs for the next year, you would have to have some type of increase in value of this account. It's too hard to track that in an internal with the insurance company. So they just said, you know what, it's just going to be $125,000 until you turn on the income faucet.
Perfect.
All right.
Perfect. Well, now we talked about this before in our segment previous about being fixed, DIA. And we talked about no variable annuities, which is probably why nobody's hearing about this because they're not publicizing it because it's not in their game. And no fixed indexed annuities, shocker there, because index is so big, so that's not going to be a play. But no income rider. Now, we just talked about the ROP. I'm thinking, wow, there's no income rider I can put on a DIA for this.
Yeah, absolutely. This, I think, is a huge advantage because it is fixed. It's got to be a deferred income annuity. You can't put an income rider on there because that becomes a paper value, and then how do you put that into the 1231 account balance? Your client is still going to have to do a 1231 account balance of every year for that other 75%. If you have an income rider on there, then that's really a little bit higher value than the $125,000 that they've taken off the table. How do you value that and things like that?
But are you saying they're excluding, in the calculation, they're still excluding, the QLAC DIA?
Exactly, yeah. So what we think will happen is that this is an opportunity for one, get back to basics. Talking about basic guaranteed income. Having that inflation protected, income that you cannot outlive, which you could certainly get that with an income rider, but at the same time, you've got base guaranteed income and inflation protection. And let's face it, most income riders really don't have any type of growth opportunity in here. The other thing is no indexed annuities, no variable annuities. Again, base level, this is getting back to basics. We see the industry kind of swing back and forth, pendulum swinging. You know, we used to think annuitizing your contract was terrible. There's a recent poll by the Insured Retirement Institute of people between the ages of 25 and 44 and asked if they would give up control of their money. An amazing 50% of those people polled said that they would be more than willing to give up control of their money if they had guaranteed income. So that client philosophy is beginning to swing back to that pension mentality that we saw maybe 20 years ago.
Mike, before we leave the show, I want to talk about, we may have to do a show on DIAs and the mentality behind it so that you can fit within the QLAC regs here. Because to me, this is so new that people probably haven't even caught up to the DIA idea. Yeah. So I think this is a pretty good, so before we leave the show, tell me a little bit about when you're looking at DIAs, is it, when we talk about life only, life cash refund, will there be life and 10 or just life only or life insurance or life and cash value? Yeah,
really anything with a life contingency is available to use.
Life and 10,
yeah.
Whatever. Okay.
So that you can have that guarantee there.
Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, and your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. See you.